Okay. Welcome along. Thanks for the invitation to speak. Certainly a pleasure to be here. Look, I'm just sort of going to build, I think, on a little bit of what Damien touched on. And I was really pleased to see him touch on the concept of change, because change is the new normal. Change is apparent across a lot of areas globally. Technology, obviously economic direction, policy direction is changing, and changing can be unsettling. You've got to take people along for the ride. And yes, that's one of the big questions New Zealand faces at the moment in regard to, can we take people along for the ride? Before we get into my presentation, just quickly a quick disclaimer, because there are now legal requirements on an individual like myself. This is not financial advice. I do not want to go to jail. This is a presentation designed to be somewhat educational, and I'm going to be intentionally controversial in places because I want to make you think. And I want to make you think about some bigger picture issues. So, bigger picture one, or challenge one, what is this a chart of? Any guesses? It is a chart of Fletcher Building share price. Now, the minister said, Fonterra is the biggest and the best. Sorry, I'm going to challenge that. They may be the biggest, but they're not the best. The best does not deliver a 50,000 hit to the shareholders, which is what's happened in the last 12 months with the losses. Now, the key thing here for New Zealand is we do not have a lot of big companies. Now, we want the big companies to be doing well, obviously, for the shareholders. They've got big, strong interest, and the companies they're investing in are going to do well. But there's a wider economic issue here. Because New Zealand does not have a lot of big companies, those big companies we have to be bellwether for the industries they represent. So you have a look at the likes of Air New Zealand. They are a true bellwether firm for the tourism industry. And of course, the tourism industry is going incredibly well. Unfortunately, if you look at New Zealand's economic history, we've had a very sad track record of blowing capital or losing money, particularly when we go overseas and invest. Now, New Zealand as a nation is not a nation where we're great savers. Now, being poor savers can be offset if you're great investors. You can even the ledger. Unfortunately, New Zealand has tended to be poor on both counts. So let's have a look at some real basic figures. If you look at the returns foreigners get when they invest in New Zealand, buy New Zealand assets, they tend to pick up the cash cows. If you look at New Zealand's track record in regard to when we invest overseas, we tend to pick up the dogs with fleas. The divergence in regard to what foreigners get when they buy New Zealand assets versus what we get when we invest overseas has historically, if you go back about 17, 18 years, 1.5 percentage points per year. Now, if we equalise that, so the returns New Zealand companies overseas were the same as the returns foreign companies were getting in New Zealand, so we were just as good, don't have to be better, we have to be just as good, the dollar amount of that, have a guess. Throw some numbers out there. Sorry? 20 what? The answer is 35 billion. $35 billion, which is about a quarter of the value of the stock exchange. So we are not talking immaterial dollars of money in regard to because we are economically underperforming in regard to where we are allocating capital. And this is a major issue for New Zealand going forward, is to get it right and use our narrow portion of savings pool more efficiently and make a lot more of a buck. Because it's not just about the investors, the shareholders benefiting, this is about more broadly the economy benefiting. A rising tide is going to lift all boats. Theme 2, the fourth industrial revolution. It is here, it is coming at us at a rate of 200 miles an hour. The first revolution looked at mechanising production. Revolution 2, that took us to mass production. Then we went to automated production. Well, the fourth industrial revolution, that's about a fusion or a collection of technologies that are hitting us at light speed. Yeah, the difference between Revolution 1, Revolution 2, and Revolution 3 versus Revolution 4, Revolution 4 is non-linear. It is exponential in speed, and it is growing in pace, and it is impacting a wide range of industries. I just saw some figures out the other day in regard to how much they think herbicide use could fall by once artificial intelligence is utilised more efficiently. And the estimates coming out of a company in the United States, which just got taken over by Dare Enterprises, is 90%. A 90% decline. Now, obviously, we're seeing the impact of the fourth revolution on a number of levels in regard to your meat patties. No longer potentially need to be meat patties. Every year I come up to field days. This year I'm joining zero. Now that's telling you something. A technology company is turning up to field days. Now this is bringing both challenges, but it's bringing threats. Yeah, the big challenge is that this is a supply-side miracle. Yeah, this is allowing us to push out the production frontier. It is allowing us to free up time. It is allowing us to be a lot more efficient with our allocation of cash. It is allowing us to be a lot more surgical in regard to how we are using data to deliver the maximum bang for our buck. And of course, for a small open country such as New Zealand, which is geographically disadvantaged, yeah, we want logistics, supply chain management to make it easy for us to connect in the global marketplace. And this is precisely what the fourth revolution is doing. Of course, there are challenges. And the biggest major challenge here at the moment, what does the future of work look like? And particularly for the younger generation. Yeah, one of the reasons, I have a look at I've got a daughter aged 8. I asked her the other day, what are you going to be, Sophie? She said, I'm going to be a YouTuber. And that is a credible career nowadays that you can make an awful lot of money out of. Now this, of course, creates challenges in regard to the future of work, because there's surveys out there at the moment that estimate anything from sort of 30 to 60% of jobs could change in nature over the next 20 to 30 years. Now, what does that mean for the education sector? What does it mean for skill demands in regard to industry going forward? So I expect and I hope that the upcoming budget has got a very strong emphasis on setting the education sector up for the future of work. Because it's a massive issue. Technology is here. It is hitting us at 200 miles an hour. It is truly startling in regard to where we are going to go to. But it's going to bring big challenges in regard to the social fabric of society. But what does it mean for firms? Well, it means disruption. And unfortunately, some of the surveys I'm seeing around the country disturb me in regard to how tech-ready a lot of firms are. Now, the short answer to surveys which are going to come out in the next month is that we're not ready. Yeah, when people think about disruption, they think about natural disasters or they think about the economy. Yeah, the biggest disruptor out there at the moment is technological advancement. And this requires some fundamentally different conversations. And it's a very simple equation if you're in business. And it doesn't matter what sort of business you're in, you need to innovate at a faster pace than the disruptors can get distribution capability. Because if they get distribution capability, it is good night nurse. Now, this stuff is possible. You have a look at industry players or firms such as Spark. You go back and have a look at Spark or the old sort of telecom 10 to 15 years ago, it's centred on the phone line. I do not even have a phone line in my house anymore. There'll be a lot of other people that'll be the same. Yeah, now we've got Lightbox. Now we've got cell phones. Now we've got broadband. You look at Spark Ventures in regard to how they've been innovating. The same sort of challenges are going to become apparent for the electricity sector in regard to how they need to innovate. But this is industry-wide in regard to the innovation channel needs to pick up. So it's pleasing to take on what the Minister said in regard to a big, strong focus on R&D-based expenditure. We've got to get those numbers up. And of course, the other challenge of what needs to take place is that boardroom discussions need to change as well. Now, the old model in regard to if you're a director used to be reasonably simple. Make sure you had good governance, but you centred good governance around two basic questions. One, make sure the firm you're on the board of had something unique, different within its product offering or service offering. That defined your ability to compete, get market share and do well. If you didn't have something that was unique, different, odds are you're going to lose market share. On top of that, you needed a team or a management structure or an organisation that has good culture. You get a different product, a different service, differentiated, and good culture, odds are your firm is going to do incredibly well. That today is a partial condition for success. What you need to be embedding within the DNA of an organisation going forward is innovation, adaptability, flexibility, the ability to shake things up and change, because that's the only way you deal with disruption, because it is not going away. Disruption. Well, there's another leg to this, because it's not just hitting us on the technology-based level. It's hitting us in regard to climate change, demographics, retirees versus millennials. Yeah, it's interesting if you look at the big debate in regard to housing, those on the housing ladder versus those that are not. It's intergenerational. The whole debate over climate change is intergenerational, wanting to leave the world a better place for our children, cleaning up the waterways. Same thing in regard to sustainability. You're thinking about the medium term as opposed to the short term. And then we have a look at retirement income policy. And there's a paradox here, because that's the one we don't want to touch. But it's pretty clear that it's fiscally unsustainable, but we're protecting a portion of society for that one and not opening up. Whereas if you look at where we're opening up in regard to facing intergenerational battles, we are facing the intergenerational fights on a lot of other levels. The next empire is the United States fading. There's some pretty serious question marks there. And you don't look at the economic data, you look at the social fabric of society. And I look at things such as the gun debate. Now, when you can't look at your own, look after your own, or you see the animosity that's brewing across America, now that's sort of a little bit similar to what we saw across the Roman Empire. It's a little bit similar to what we saw across the British Empire. Yeah, the cracks are starting to open up. Liquidity versus fundamentals. Now, for the past 10 years, it's been a liquidity-driven investment mantra, the old credit accelerator model, provision of capital, cheap, low interest rates. Global central banks kept rates low. That's kept asset valuations high. Well, the US Federal Reserve is now lifting rates. Liquidity cycle is starting to turn. Prudential policy, taming leverage by bank regulation, as opposed to using the interest rate lever. Government policy shock. Yeah, the missing middle of society is pushing back regulation, and so it sort of goes on. The global economy. On the face of it, the global economy looks pretty good. And that's welcome, because demand is a critical component of commodity price strength. Now, you start to see the demand indicators around the globe start to temper, and typically you start to see the commodity price cycle turn as well. What we're seeing of late is a little bit sign of turn within some global economic indicators, in particular the manufacturing indicators. But more broadly, the global economy looks pretty rock solid. If you look at the world's largest economy, good old Uncle Sam, America, Uncle Sam has got an unemployment rate of 3.9%. Yeah, that is eye-wateringly low, and a sign that the economy is going very well. The fact that the US Federal Reserve has been lifting interest rates is a good thing. It's a sign that the world's biggest economy no longer needs the interest rate support that low interest rates provide. We all talk about Trump. Well, thankfully, other leaders are starting to step up across parts of Europe. And of course, it's been interesting to see the debate in regard to challenges can bring. You know, one of the big interesting stories I've seen in the past 3 to 4 months has been how the children or the kids in America have reacted to the gun debate. That's a sign that the social conscience of society has really been pricked. It's actually driven a counter view. You are seeing sponsors of the NRA, the National Rifle Association, are deserting them. So I look at those sort of things and I take a glass half full interpretation. I think that's good. It's a sign that some change is going to take place. And of course we've got buoyant commodity prices. The glass half empty version for the bears is centred around what we call the 6 horsemen of the apocalypse. And the 6 horsemen of the apocalypse are more broadly: 1, productivity growth around the globe is weak. 2, demographics are poor, so the population is ageing. And pretty well every country around the globe, apart from Philippines, Indonesia and India. But we're at peak person. Germany, Russia, Japan, America, New Zealand, China, we are facing demographic headwinds. Headwind 3 is global debt. Global debt is now 220% of GDP. That is higher than what it was prior to the global financial crisis. You've seen organisations such as the Bank of International Settlements and other central banks around the globe are alert to the potential impact that could have as interest rates start to move up. Horseman 4 is that the policy ammunition or the armoury is pretty well empty. Government debt is around 80% of GDP around the globe. I do not know why people get out there and say New Zealand has got too much debt. Government debt is 20% of GDP. Global equivalent's up around 80. If anything, we're under-leveraged. We should be using our balance sheet a little bit more. But globally, interest rates are still low, so we can't cut interest rates if things go pear-shaped. And of course, fiscal policy is somewhat constrained. And Horseman 6 centres around Donald Trump. And Lord knows what he could tweet from night to night. And it's rather frightening to see financial markets reacting to what we now call as tweet risk. We're less concerned about economic risk per se. Markets are not responding to the economic data. They are responding to the tweets he's sending out. And of course, the protectionist breeze is growing a lot louder around the globe as well. Now, at the moment, the global scene, I think, looks pretty well balanced. Now, statistically, unfortunately, we are due a correction. Now, that does not mean a correction or a downturn is pending. But what it means is that when you're late cycle, you've got to keep your eye on things. You've got to be careful. Because I give you the laws of the number 8s. We had a recession in 1978, 1988, 1998 and 2008. So you don't have to be too clever to be an economist when you look at the 10-year cycle. Now, my personal view is that this global expansion has got a little bit more legs. But the warning signs are starting to increase. And the big warning signals are areas you need to look at from a New Zealand perspective. Don't look at global growth. Because by the time we get the global growth numbers, the horse is bolted. What we look at is what we call the 6 C's. Confidence. Whether people are confident or not. The potential for contagion risks. Whether we start to see things move in a correlated manner. So if we start to see the global equity market and the big bellwether here is America, if they start to set off ripple effects elsewhere around the globe, cost of funds. New Zealand borrows a lot of money. We are reliant upon offshore capital because we do not have a great savings pool in New Zealand. That makes us reliant upon global lenders. If we start to see global cost of funds move up, it's typically a sign that something is going on. Commodity prices, they can move, very symptomatic with developments in the American economy, industrial production and China. Currency, the New Zealand dollar and the Australian dollar tend to move at light speed when something's happening around the globe. So if you start to see them move and you start to see 1 cent movements overnight, it's normally a sign that something is going on. And of course, the final C, which we keep very close attention to in New Zealand, is China. Because China is one of the world's biggest economies. It's growing rapidly. We need to be there. But of course, China has got a lot of debt. In fact, China has been funneling up debt at an exponential rate over the past 7 to 8 years. And they've got a model where investment dominates. So investment is around 45% of GDP. And that is a sign of overinvestment, and you actually wonder about whether we're putting all the money in all the right places. Now, at the moment, things look okay. But if we start to see those 6 C's start to move a little bit, watch out, because that will be a sign that we're set for that 10-year pattern to start to repeat. Theme 6, borrowing costs. Can interest rates remain low? Now, we're seeing around the globe at the moment, the global cost of capital, particularly in America, has started to move up as the US Federal Reserve has been lifting rates. As inflation's got to target, unemployment has fallen, and that's a good thing. The risk here is that increases in American interest rates start to drift up or buoy the global cost of capital. Now, at the moment, we're not seeing that, but over time we would expect to. If I look at the New Zealand inflation situation, we're caught between two contrasting forces. The contrasting force one is technology. The technology is still massively deflationary. In a world of disruptive technology, the Airbnbs, the Ubers, all this sort of stuff, it's hard to see where the inflation is going to come from. If people are at risk of losing their job, they're not going to put their hand out for a big pay increase. So we're not seeing a lot of wage inflation. And wage inflation has traditionally been a big driver of general inflation. The property market's slowing up, and if the property market's slowing up, that's deflationary, not inflationary. The flip side is pressures from the labour market as the social justice version of capitalism comes more to the fore. Look, there's nothing wrong on the face of it with the minimum wage going from $15.75 to $20. We want people to be earning more. The challenge for the economy is that if we get increases in wages that are out of sync with productivity growth, that puts pressure on business costs. And businesses will try to recover those costs. And that's when you can start to see the inflation story unlock. So at the moment, we know the minimum wage is going up. That's fine. But you can bet that if someone's on $19 an hour at the moment, they're going to want 23. If someone's on 23, they're going to want 26. If someone's on 26, they're going to want 28. And so it goes on. Now, that's the story to watch in 2019. But at the moment, it looks like the inflation story is broadly balanced, and it doesn't look like the Reserve Bank will be lifting interest rates for quite a while yet. Theme 7, cash flow versus capital gain, and the Minister touched on a little bit of this. Now, productivity growth, efficiency, intensification, there's strong commodity prices. The economic fundamentals have been there or thereabouts in regard to supporting investment returns for the past 20 to 30 years. But one of the big drivers of investment returns over the past 20 to 30 years is what we call the credit accelerator model. That has just been the provision of credit at lower and lower rates. And that has allowed success to breed success. Rising asset prices has allowed more leverage into the system, and then asset prices get another kick up. What we've been seeing, and this is intensifying of late, across pretty well all asset classes, we've got stretched valuations. Banks are tightening up the availability of credit. Regulation, I suspect, is going to accelerate that. Growth is in a mature stage of the cycle. Foreign investor restrictions are here, or at least pending. The precise shape or form is still open to a little bit of contention because Pandora's box has been opened there, and of course we've seen basic interest rates. Now, you have a look at the property market. The property market doesn't just have that combination being slugged at it. You've got the removal of negative gearing, that's around the corner. Now, the losses that people used to lose are now going to be ring-fenced away from your primary income. Restrictions on foreign buyers, capital gains tax, shift in the landlord-tenant style relationship, they are big fundamental shifts. And of course, if you ever look at the yield on an Auckland residential property at the moment, it's around 3%. Your cost of funds is mid to low fours. In the absence of capital gains, you're losing dough. And what you're seeing at the moment across the investor market is that the market is starting to wake up. And the investors are going to start to flee. Now, the similar challenge I think is going to happen across the dairy sector. The return's typically 10%, about half cash and half capital. In a world where, I think we are at peak cow, intensification is going to be hard to etch out, abstracting from technology. Conversions, well, they're flattening out, and the production curve is flattening out as well. And then you've got new environmental taxes. And it's not the individual tax that hurts, it's the combination. So what we're expecting going forward is that asset price growth is going to level out. And I noticed David Parker on the weekend, he got pushed around by Corin Dan in regard to have they done any work in regard to what the transitional consequences could mean for the economy as we shift to a different economic model, whether it be production caps or that stuff. But I'll give you some real basic numbers. The New Zealand economy typically can grow about 3% per year on average. That's about 1.5% productivity and about 1.5%, maybe 2% growth in the working age population. But that's sort of what we can do. Now, if you look at sectors that are directly under the gun at the moment in regard to government policy, it's about 10% of GDP. This is oil, mining, and parts of agriculture. Now, in all likelihood, those sectors on a volume basis are going to give us a 0% contribution to growth. So you can wipe 0.2, maybe 0.3 percentage points off your headline growth figures. So 3% becomes 2.7, 2.8. On top of that, the credit accelerator model, or the creation of wealth through rising asset prices, has probably been responsible for about 20% of the growth in consumption expenditure across New Zealand. Now, consumption expenditure adds about 1.8 percentage points to GDP growth every year. Now, you multiply 1.8 by 0.2, you get 0.4. So my simple back-of-the-envelope calculations give you potentially in the next 2 to 3 years an economic hit of 0.6 percentage points to GDP. Now, that sort of stuff is non-material. Now, if that sort of stuff is levelling out, and to be perfectly honest, I agree with where the spirit of the policy prescription is going, we've got to do it. The issue or the big challenge, and this is the unanswered question, where is that replacement growth going to come from? How do we transition? How do we move from the old to the new? What does the process of change actually looks like? It is not change that is the challenge. It is how we manage, take people along for the ride, and identify the opportunities on the other side of the equation, because there is going to be a growth void. Positive story, theme 8, prospects for cash returns look pretty good. The global backdrop is okay. As I said in theme sort of 4, it was balanced. We don't like the Horsemen of the apocalypse, but for now the global scene looks okay. Milk powder prices look to be oscillating around the top of the ranges. We're noticing a little bit of a gap between New Zealand pricing versus the rest of the world. Probably looks a little bit stretched. Rubber band maybe a little bit tight, but not a clear signal there. China's well stocked. Weather production, still the big swing variable. But the real big kicker, or the one we could potentially see here that could put the dairy sector in a cash flow sweet spot, could be movement in the New Zealand dollar. At the moment, we have a situation where US interest rates are heading higher than New Zealand. Now, normally that sees the New Zealand dollar down around 60 cents. Now, I don't think the New Zealand dollar is going to 60 cents, but I can easily fathom a case where the New Zealand dollar goes to 65. And if we can see commodity prices hold or even just be a little bit weaker, and we get that 10% sort of kick from the New Zealand dollar, and 65 is still historically on the high level, the cash flow returns are going to look pretty good. Theme 9, the economic transition. The old economic drivers for the past 4 to 5 years across New Zealand has been migration. Well, we're at peak migrant. Tourism. Well, talk to the hotel operators in Auckland, because they reckon we're at peak tourist. We just can't bed too many more people. Housing, flattening out. Construction, we don't have the workers to build more stuff. And of course, low interest rates, it looks like that game's over. So what we're doing as an economy, we're looking for moving from previous growth model to something that's a little bit different. The good news is there are new drivers. Yeah, the government's spending a lot of money. Now we can argue the benefits or pros and cons of that, but fiscal policy is going to be a big driver of economic growth in the next 2 to 3 years as they put more money in people's pockets. And of course, that's going to provide a bit of an income boost, particularly to middle, low-income households. Commodity prices are buoyant. Our terms of trade are at or near record highs. That should be stoking the fire across the rural communities, subject to one big caveat, which is uncertainty, which I'll talk about in a second. And of course, the new driver could be that weaker New Zealand dollar. The problem, these transitions are never easy, because what we've got stuck in the middle is what's called uncertainty. And there's an awful lot of it. And I'm going to talk about the economic impact of uncertainty in the next slide. We've got to get productivity up. All the public sector crowd out the private sector. The public sector wants to build an awful lot of houses in Auckland. I don't think they can build all those houses without crowding out the private sector, because it's just not the physical manpower or lady power to actually put the units up. And of course, we've got to look at the economic cost of capping some sectors. Yeah, that transition I talked about, or if I just do some basic maths, I can knock 0.5, 0.6 percentage points off GDP in the blink of an eyelid. And that's the sort of stuff that has not been looked at. Uncertainty, well, it matters. If you look at a real basic model of investment, you've got 3 basic drivers. Driver 1 is the economy. If the economy's going pretty well, there's a very strong incentive for firms to invest. It's called the accelerated channel. Channel 2 is what's called Tobin's Q. So if the market value of assets is rising at a faster rate than the replacement cost, there's an economic incentive to invest, build more stuff. And the third channel is uncertainty. If things are certain, if things are stable, you get out there, you'll take a little bit of a punt. Now, what we saw in the 2000 period was there was a de-linking between the uncertainty channel and investment. And what happened during that period was that the economy is strong enough to ride the investment tide. Property values were rising more than the replacement cost of putting up a building. So the top 2 channels, growth and Tobin's Q, dominated the uncertainty channel. If you look at what we've got in New Zealand at the moment, the economy's not exactly knocking the ball out of the park. We're okay, but we're not what you call strong. And what we are starting to detect, and it's coming through certain markets, is that asset values are starting to flatten out. And they're flattening out at a time replacement costs are still going up. And that's an incentive to stand pat as opposed to invest. And of course, what we also know is that uncertainty is pretty high. We're seeing it come through those surveys. Now, this does not mean it's going to dominate, but it's an issue because firms need certainty. We need stability. And this, once again, I think comes back to the big issue is not change itself. It's the transitional arrangement and what are the growth fillers. It's the plan on how we're going to get there. Everybody's along for the ride. We're just not quite sure what that ride looks like. And the real risk is that uncertainty comes and dominates in that instance. Theme 11, there's a lot of talk out of Wellington in regard to wellbeing. It was a term the minister uses. It's a lovely term. What does it mean? And the answer is we don't really know. It's got lovely connotations, and touchy-feely. And more of an emphasis on social metrics, well-being, living standards, all these sort of things, admirable. The issue is, if you look at some work that the IMF has done, where you measure welfare versus GDP growth, or GDP per capita, lo and behold, there's a 45-degree angle. There's a strong relationship. So what's the message in this? The message is pretty simple. You've got to earn $1 before you can spend $1. So all the talk about living standards, we want to raise them, well-being, we want to improve well-being, we're to deliver on social outcomes, admirable, we want to be achieving those, bottom line, you've got to make a dollar to actually be able to achieve that. Should not overlook the earning backbone of New Zealand because we need to make the dollars. The upshot, just to wrap things up, big messages, change is the new normal. Ignore it at your peril. Now, change is not the issue. It is how we get there, how we take society along for the ride, and the plan. And the plan, unfortunately, I think, is the missing middle. And that is what is unsettling businesses. That is what is unsettling an awful lot of industries. The global economy on the face of it looks pretty good, or average. But watch the big 6 C's. If you start to see them move, it's normally a sign that something's up. At the moment, we've seen a little bit of movement, but not a lot. The main one I'm watching at the moment is cost of funds. If I start to see those start to move out a little bit more, that will be a worrying sign. Key local issues, look, I think the New Zealand dollar is still going to weaken. My personal view is 65 cents in 12 months. That could provide a lot of cream into the dairy sector cash flow-wise if we can get the commodity prices holding up. I think the sector's going to need that cream because the credit accelerator model is past. We are transitioning to a different valuation model. It is a valuation model based on across various sectors that is going to be increasingly focused on the cash flow underlying yield return. We've had a couple of cracks at doing that. Post the GFC, there was a big strong focus of it, and then we got back into the old style behaviours. This time around, I think that structural shift is a lot more structural. It is going to take place and be embedded. We need that new growth model. We need to identify those growth alternatives. That's the missing middle, the challenge for New Zealand at the moment. Change, I think everybody's along for the ride. We understand what we need to be doing in regard to the environment, climate change, water quality et al. It would be nice if those intergenerational issues were fair. So we looked at the big elephant in the room, which is retirement income policy as well. Why that's not an intergenerational issue is still sort of lost on me. But uncertainty, final issue, it's high. We need it to come down. The only way uncertainty is going to come down is to articulate a clear and sound plan, and that's what we need to see over the next 12 to 24 months. Thank you.